Critical trade alert. Prepare for hyperinflation in food and energy costs in 2022. The global elite have forced Putin to escalate the war, and I'm expecting inflation to remain hot until this war ends. To be fair, it's gone on much longer than I anticipated. And so it's going to be critical that we hold on to two stocks to protect your wealth until this war ends, because we're going to be looking at high levels of inflation, which is going to be very bad for the bond market. And if the bond market's crashing, it really forces investors into very specific assets. Now, our top selling advisory is up 13.5% in 2022 with only 3 stocks, super easy to follow. Most investors getting slaughtered, down 10%, some people down 20, 30, 40%. There's been some pretty horrific sell-off since December if you're just playing what was hot over the last 2 years. Now, last year, this exact setup, slightly modified, returned 233% in 2021, turned every $10,000 into $33,000. What I'm going to cover now is the current trade alert recommendation for $10,000. If you had 20, double it. If you had 100 grand, multiply by 10. Step 1, pick up 80 shares of UVXY. This is our stock crash insurance. This is not an ETF that just shorts the market. It's more like insurance. So you need a devastating stock market crash for this to really go up. Last time we had a serious sell-off, a panic with limit down days. UVXY went up 1,100%. That was during the lockdown, the global lockdown in March of 2020. Now, if this energy crisis keeps going on for too long, we could very well end up in a similar situation. And then again, here's a look at UVXY this year, doing a great job protecting the portfolio. It's been up as much as 80%, currently around 65%. Step 2, prepare for a de-escalation. If energy costs fall, this asset's going to rip higher. In fact, I think it's going to rip higher almost regardless, starting now. So we're starting to see the signs of a major cryptocurrency short squeeze underway. The big whales have been buying the dip. They've been taking the Bitcoin off of the centralized exchanges. All the big money is getting in on this space. And so we're a firm believer the single best asset you can hold this decade is Ethereum. We're long the ETHE OTC stock, which is currently trading at a discount. So the way this works, they did a offering and essentially took accredited investors' money, bought a bunch of Ethereum with it, then listed it in the stock market. So this is actually trading about 25% below its fair value. So beautiful time to go load up on ticker ETHE. For every $10,000 you're investing, I would be picking up 201 shares, and I see no less than 10 times growth for this asset in a 5 to 10 year stretch. Potentially a double or triple by summer, and we're expecting the cycle to last about 2 years based on the dot plot of the Fed. And that's essentially how long they want to wreck the bond market until it matches up with inflation. So we'll talk about timing the sale, but we're basically looking for a double or triple in Ethereum over about a 2 year stretch, and then pull out and get ready for a big crash to buy back into before we go into the next 10-year cycle. So again, we'll walk you through all of that in today's presentation. And I could be under promising dramatically the potential returns in this space. So if you've been long Ethereum since 2017, you're up 19,000%. Okay, so that's 192 times your money. Absolute insane returns to be long Ethereum with a very simple buy and hold strategy. Now, if the bond market's going to be disrupted by energy costs remaining elevated as long as this war goes on, and it's looking like it could go on much longer than anyone originally anticipated, we want to be long either oil or natural gas. And so we've seen oil hit 134, come back down to 100, very volatile. The key commodity that's not really gone skyrocketing up yet, where I see value and much more upside potential, is natural gas. Now, oil's playing the spot price in the US, but we can see what's potentially going to come. either Putin or Germany and Europe are going to start playing around with the revenues for natural gas to Russia. So Russia could cut off supplies to Europe and cause massive problems, or we could see the European Union start to reroute orders to the U.S. and try to stop buying Russian natural gas. Now, as this war has broke out, the purchases have actually ramped up. They're buying more natural gas than ever before from Russia. And so they're essentially funding this war. Now, the plan is over the next year is to reroute those orders. So again, this is going to take a lot of the supply off the market and reroute it to where we're positioned with Boyle. So we're looking for this to potentially double, triple, or quadruple if it's a peaceful rerouting by Europe. If Putin goes in and cuts off natural gas as a war tactic, you could potentially see a 10 times return on Boyle. So very important inflation hedge. And currently the way we're playing the market against inflation. And so the Russians do play around with the natural gas. Last year, we actually saw Boyle hit 100. And that's when they cut the supply, which is flowing through Ukraine, in half. And so far, it's been the opposite. They've been letting this flow and the sales have been ramping up. And this is how Russia is really fueling their economy, through the oil and energy sales. Now, what's really interesting is they're now selling their oil $20 to $30 below market prices. So people like India and China are very excited to get this cheap oil. And the big problem that could come from this would be the US essentially starting to pick on probably not India, but potentially China if they continue to support Russia. And so unfortunately, that seems to be the way this is rolling currently. Very important hedge. We'll hang on to Boyle until this conflict really resolves. And so far, just doesn't seem like there's any intention by either party to resolve this. Now, if we look at it in a table, we're currently long 13% of our portfolio in the crash insurance. Now, what makes UVXY go up? Usually it starts with some product going limit up or limit down and catching people who were selling options against that or futures contracts. They get into a position where they're not just losing all their money, they're losing more money than they invested. And so if we see extreme volatility in important markets like copper or steel or oil or even wheat, up or down, it's going to create significant losses. And when people go negative, they have to start selling everything they own to try to stay solvent. And this can create a cascading domino effect. So I look at UVXY as the bankruptcy hedge. If some big players start to go bankrupt and have to liquidate everything, and it creates a domino effect, this can create these extreme sell-offs in stocks that makes UVXY go up. Now, again, it's not like shorting the NASDAQ or the S&P 500. It actually has what's called an asymmetrical return. It will go up faster than stocks go down. So again, it acts like a crash insurance. Now, right now, for every $10,000 invested, we have 80 shares in UVXY, and it's at about 13% of the portfolio. Just as of Tuesday, it was up to 17.5. But if you're following the program, we've picked up massive profits since Tuesday in both portfolios without touching the crash insurance. Now, this is probably more of a short squeeze in the option market. There was trillions of dollars that were in the money in put options. And by pushing the market higher, the big money makers who sold those put options were really saved. So we'll see if this market keeps rallying into next week or if we're going to have more volatility. And I think it'll probably, the volatility is most likely to occur when there's escalations between Russia and NATO. And more specifically, if there's some sort of embargoes on their exports of energy products. That's what's most likely going to ramp this up. And we'll talk about some of the other headlines. There's rumors of a chemical attack, bioweapons, all kinds of false flag claims by both parties of how this could escalate. So far, it's been pretty calm this week in terms of escalation. Meanwhile, we've got 201 shares of ETHE. This is the core asset that we see growth in, long-term value. It's growing faster than the internet. Okay, you got to realize Ethereum is growing on a user base faster than the internet. Let that sink in. Okay, if it keeps up this pace, there's just extraordinary returns simply holding this. In fact, our whole portfolio is designed to allow you to buy and hold Ethereum over this next decade. And I really think it's going to take 2 to 3 decades for the growth to really slow down. And that's based on looking at how fast companies like Apple and Microsoft took to really mature their markets. And so you got to realize investing in Ethereum today would be like investing in Microsoft when it was 5 years old. So beautiful opportunity. You're not too late. You're very, very early. And I work on really the inner workings of Ethereum and the plumbing and the technology behind it. And it's super, super basic stuff at this point. It is not like a flashy phone app that's user-friendly. It is slow, cumbersome, and is really in its infancy. So this is our favorite growth asset for investors over the next several decades. I'm expecting a nice ramp up into summer. And then I do think this cycle will end in about 2 years. We'll look at why. We'll look for a crash and then buy back into it. I'll explain this and why it's really just the Federal Reserve is going to control this cycle. So it's something we'll cover when we look at the federal funds rate and again, the bond market. We're not in NRGU yet. If you give me a little bit cheaper oil costs, we did see oil fly from 134 to 100. If you give me oil a little bit cheaper, I would be willing to cut our BOIL in half and be long NRGU and BOIL just to diversify our inflation hedge a little bit. Right now, the asset that has not gone skyrocketing to new highs is natural gas. And it's just been because Europe would go lights out. So they are planning to reroute these orders. It's just taking them some time to do this. And it looks like these sanctions on Russia are not going to end, and Putin has no plans to end this war. If anything, Ukraine may not be the last target for his expansion here. So we'll cover this and more. But this is the asset allocation. You're 13% long crash insurance with UVXY, 80 shares. You've got 48% long Ethereum, trading at a 25% discount compared to what the OTC stock has on its book. So you could actually outperform Ethereum here. 201 shares. And then we've got 90 shares of BOIL. That's the spot price of natural gas North America. And the expectation is Europe's going to slowly but surely stop buying Russian gas and start shipping it in from the US. And obviously that's going to cost a lot more and drive these prices higher. So either Europe does it willingly or Putin does it as a war tactic. Either way, critical hedge for the portfolio. And the big money for Putin is the oil, not so much the natural gas. Natural gas being cut off would be a very good tactic to hurt Europe in an escalation. Another reason why I like that one so much. Now, again, if de-escalation occurs, expect energy costs to fall. Food costs are probably going to be screwed this entire year. Hopefully we get food costs down next year. There's going to be massive amounts of starvation in poor countries this year. So a lot of uprising in poor developing countries. But what we're going to look out for is if there's a de-escalation, oil could quickly fall back to the 80 range. So we got to be ready for that and understand that's when you want to sell your bond hedge. And so here's a chart of oil. And again, you can see if it gets to these levels, it could stay up there for perhaps 6 to 12 months, but it will wreck the economy and eventually create a recession and a crash. So we got to be careful playing with inflation hedges in commodities at this elevated of a level and realize if there is a peace or a truce and these sanctions come back off to get out of the way. And what we'd expect would be bond yields to fall. So that means the TLT is going up. And at this point, we'd rather be long Ethereum or the NASDAQ than bonds. We'll talk about when we want to go long bonds, but we're not there yet. Now, falling bond yields, which I expect to probably play out for the rest of the year unless these energy costs keep rising. So that's the caveat of all of this. Likely to moonshot cryptocurrencies and tech. So as long as the bond market stops crashing, it could just trade sideways from here. It's going to be extremely bullish for tech stocks and especially cryptocurrencies. And again, there's that massive 19,000% return from 2017 to current. And note, when we're doing rate hikes and expansion of credit, you can see that's where Ethereum went from the super low value in the hundreds and rocket shipped up to 1,000. It did crash, and we'll talk about what happened in 2018 to cause that crash. Bottom line, it's when bond yields match up with inflation, comes a black hole for markets. And that's when we want to go very aggressive into bonds. So once again, the last time the US was tightening, which we mean raising interest rates and potentially letting the balance sheet shrink, and China was expanding credit, which they're doing out of necessity to protect their real estate market now, Bitcoin went up 4,400%. So this is the exact environment we had last time approaching right now. In fact, we just started it on Wednesday with the beginning of the rate hike cycle. And China came in with massive money printing. That's why you saw emerging markets jump up extreme amounts on Wednesday. And there's that chart for you. Now, if you know what happens next, this chart doesn't end nicely because that's the exact moment when the bond market became attractive relative to inflation and it crushed cryptocurrencies back down. So right now, cash is trash. We've got governments spending more money than they make. And this is going to be a phenomenon most likely for the rest of our lives. It's a demographic problem and it's a technology problem. Essentially, too few people to support the retirement, the folks going into retirement, and technology is replacing jobs, not creating new jobs, as it has for many centuries in terms of new technology. So at this point, there's no reason to think any government's going to spend less than it makes. They're all going to spend more than they make. They're going to have to expand debt, and they're eventually going to have to suppress interest rates by doing quantitative easing, buying their own debt, printing money. Now, bonds are not going to be attractive until they catch up with inflation. So the longer inflation runs hot, the longer the central bank's going to have to hike rates and make bonds, interest rates go up higher and higher. So that magic moment will be the time to go long bonds. I'm anticipating it's going to take 2 years to achieve. So until then, investors really have no other logical option. That's why stocks, cryptocurrencies, commodities are going to continue to melt up until there's an alternative. And the only alternative that's interesting are, again, passive income from bonds. And those are not going to be attractive when the inflation rate's at 8% and you make a measly 2.5% lending US government money for 30 years. So again, that's going to be the magic moment to make big changes to the portfolio. And I'm anticipating we're about 2 years off of that. So it's critical you watch our webinar every Monday, Wednesday, Friday, and be ready for sell alerts. Okay, I'm going to jump into some data here. Okay, we'll start off with the news feed, look at some headlines, and we'll look at some data. Lynn Alden says this could change anytime, but frankly, the Bitcoin price chart currently looks better than it has for quite a while. So it's been stabilizing. What we've really seen is the big whales have been buying up crypto on the centralized exchanges, and then they're pulling it out. So that's a very bullish sign. On the way up, we see the opposite. We see the big whales importing or depositing crypto into the centralized exchanges and dumping. So it's been the polar opposite. We're very, very bullish here on cryptocurrencies. Bank of America says the inflation shock is not over. The rate shock is not over. Recession shock likely in the second half of 2022. I agree with that. I'm expecting rates to have a relief rally till about summer, and for this to be extremely bullish for cryptocurrencies. And then if energy costs aren't falling, we're probably going to get some pretty nasty interest rate hikes from the Fed. They're talking about doing 50 basis point hikes, um, maybe more than once this year. And again, that will knock the bond market even lower. Fed Bullard says the proper policy would raise the federal funds rate above 3% by the end of this year. There's no chance in hell that's going to happen. They tend to do that. They come out and test the waters with very hawkish talk to get these expectations into the market. And then they deliver a lot less in terms of tightening monetary policy. So we'll have to see what energy costs are when we approach the next meeting, which is in May. Okay, Putin has this huge stadium promoting the pro-war in Moscow. So it's not ending anytime soon, I'm afraid. I highly miscalculated the intentions. It's almost as if the plan has nothing to do with sacking Ukraine, but perhaps more to improve the trading volume for the yuan, to weaken the dollar, and to drive energy costs higher, which essentially can bankrupt the US bond market and force us into more QE. So very interesting what's really going on here. Ukraine's position unchanged in talks with Russia, negotiator said. Earlier today, members of Russia negotiating team said Moscow and Kiev are most aligned on Ukraine's neutrality and giving up on joining NATO. Ukraine accused statements of attempting to provoke tensions in the media. Peter Zahan says we now have shortages in phosphate and potassium and nitrogen fertilizers, none of which can be fixed with less than 3 years. Even if the war ended today, it's too late to generate the necessary fertilizers for 2022. So yeah, food costs are going to be probably elevated for the next 2 years. Russian President Vladimir Putin issued an early warning to foreign powers at the outset of his invasion of Ukraine. Russia's considerable nuclear arsenal was ready to deliver a crushing blow against those that meddle in Moscow's affairs. So far, Russia really has not retaliated against anyone outside of cutting off the fertilizer products. So they want the money selling the energy, and they're actually selling it at a discount. So they haven't used that to as a war tactic yet. And in the same breath, Europe's not putting embargoes on those energy exports either. And so what we're seeing is a lot of people just buying it up at a discount, despite the sanctions the U.S. has put. Jim Bianco says 2 days after the Fed meeting, market is pricing in a 40% probability of a 50 basis point hike in May. It's also pricing an 88 probability of 4 hikes by June. So one of the next 2 meetings has a 50 basis point hike. And again, it seems in general their tactic is to talk up this super hawkish talk and then deliver less. And the markets so far really like it. There's no evidence to suggest Putin's overall intent in Ukraine has changed, despite the invasion failing to reach its original objectives. Gazprom uses Ukraine gas pipelines at maximum capacity. Russia's gas monopoly is currently sending over 105 million cubic meters of gas per day through Ukraine, according to Ukraine's gas transmission operating system. In January, Gazprom had cut its daily volume of gas transit via Ukraine to Europe to about 50 million cubic meters, the lowest level since January 2020, creating a spike in energy prices. Now, we saw a boil spike around September to 100, or just shy of that. So we got to be patient with that boil play. Peter Zahan, the EU just put Russian iron and steel under sanction. Russia is the world's top semi-finished iron supplier and the 4th largest steel exporter. So again, this is just going to keep inflation elevated and really be detrimental to the bond market the longer this goes on. And it forces investors during this period to buy anything else. Marissa asks, how will our portfolios be hedged? Well, yeah, we just went over it, Marissa. You're extremely hedged. You're more hedged than probably 99% of investors worldwide. Half your portfolio is currently hedging you against this war. Boyle and UVXY. Zelensky aide says won't negotiate an inch of Ukrainian territory. This is more of a joke. Theory as good as any, Satoshi Nakamoto was sent back in time from the dystopic future with a blueprint for something that would kill the otherwise inevitable Skynet of money, central bank digital currencies. JP Morgan's Marko Klonovic says 5 reasons to remain bullish on risk assets in 2022. $230 billion coming out of bonds into equities. Russia has not been defaulting on its bonds. This was anticipating problems in the liquidity markets, the money markets. Market positioning is downshifted as evident by low equity positioning by momentum traders. So he's saying CTAs are going to come in heavy. And we keep seeing these little headlines about a ceasefire, but I'm not so sure that's really in the cards anytime soon. He's actually saying the rise in oil prices will create supportive flow for energy stocks and stock buybacks for the oil companies. Housing market cracking. Some who had previously qualified at a 3% mortgage rate are no longer able to buy at the 4%. So the mortgage rates have been skyrocketing. I'm starting to watch new housing sales. So far, no slowdown, but those interest rates have risen rapidly. So we'll keep a close eye on that housing market. While you're living your life, 250,000 human beings in Mariupol are slowly dying without food, water, heating, and almost without chances to escape from the city because of constant bombings from Russia. CNN says soaring gas prices are hurting Americans. It's time for more stimulus checks. So the Democrats are trying to blame the inflation on Putin exclusively, when we know the reality was it was all the money printing over the last few years, which, to be fair, was mostly done by Trump and the Republicans, and only $2 trillion in stimulus from Biden. So if we tallied it up, around $5 trillion came through under the Trump era and $2 trillion from Biden. It was really the last 3. So right before Trump left, he did $1 trillion in stimulus. And then Biden's first thing was $2 trillion. It was really that $3 trillion right there that overdid it and ruined the bond market. We'll look at the yield curve to see what that looks like. A lot of bad press coming out about Hunter Biden. That was clear as day true, but it was hidden by the big tech monopolies. And so Live Monitor is saying it looks like they want Joe Biden out to put someone else into the presidency race for 2024. Here's a look at some of the commodity spikes. And the point of this is to realize they go skyrocketing up and then they crash. So we want to be very careful playing natural gas at this level, and especially oil above 100. So again, we know what the reason why these energy costs are elevated, and we know what would let them come down. So carefully monitoring that as the key priority here. Biden will release his 2023 budget request March 28th. They just pushed through $1.5 trillion, and it's not going to even finish this year off. So the government's already spending quite a bit more than it makes. And Savon Henrik says, have fun financing the debt with a 3% effective federal funds rate. I don't think they'll get anywhere near that. Draghi says EU Commission should set caps on gas prices, price controls. Chai Girl says price controls may be enacted with the best of intentions, but they rarely work as intended. This may very well increase consumption, leading to further shortages. Pretty much playing with fire here. Meanwhile, the strategic oil reserve of the US is down to 30 days worth of oil. So they've completely drained that off. General Staff says Russia's almost exhausted its entire stockpile of missiles. Russia's military industrial sector is working around the clock to replenish its stock. Putin says illegitimate freezing of some of the currency reserves of the Bank of Russia marks the end of reliability of so-called first-class assets. US and EU have defaulted their obligations to Russia. Now everybody knows that financial reserves can simply be stolen. So this and the freezing of the truckers in Canada were the two best sales pitches in history for why you want to own Bitcoin, in my opinion. There are a lot of indications that China is doing more behind the scenes to support Russia financially, economically, and militarily. If they continue on this path, it'll be a turning point that will likely lead to much deeper anxiety between US and China. Alf says few zombie companies are going to find out that their business model is not viable if they have to refinance at much higher corporate bond yields. He's saying 6 to 7%. So we'll watch that Russell 2000 and the junk bond market to see problems. And we did. We got a big leg lower in the Russell, but it's been stabilizing. And it looks like the crash in all three critical bond markets is over for the time being. It's digested the rate hikes and it's digested these elevated energy costs for now. And then just like that, after our negotiations with China are over, the Shenzhen iPhone factory resumes production, just like that. So they went and locked down a bunch of districts as we went into talks to show us, look, if you mess with China, they can essentially kill our tech sector with a snap of a finger, at least Apple. And really, just about all of our goods and services come from China. Today was a $3.5 trillion triple witching event. A lot of people are expecting potential jump in equity prices today. But Nomura Bank was saying perhaps it would happen Wednesday, and it sure did, with only the 25 basis point hike. Ukraine's Air Force, 14 Russian aerial units destroyed on March 17th. So they're doing a good job defending their territory, but how long can they do this? And it looks like Russia's starting to bomb anything trying to come into Ukraine now. Let's look at the interest rates on mortgages going straight up. So yeah, this is not good for the housing sector. So far, the housing sales have not slowed down, but that's on my watch list now. Okay, here's an interesting thread on China. When people say China can stimulate XYZ, do you understand the average home is 50 times income? They have 70 to 90 million empty places now because most of the population can't afford anything. They have 20 years supply getting built in addition to that at current demand. 90% of high-speed rail lines they have built have no economic purpose. People take trains they can't afford or fly. One kid means each couple has to take care of their parents alone. And trust me, over there, parents are elders still. The growth engine left is exports, and near every country in the world wants to build more industry, move supply chains. Even worse, Western companies are well aware of changing winds. You want a few billion in China when they move on Taiwan? Want the risk? So what's left? Tech? They don't make anything all that innovative outside of TikTok. Hardware is fine, but they need our chips and IP. So what's left? Nothing. 4 to 5% growth at best. This is still an emerging market economy by any metric but size. That's absolutely awful. If anything happens to real estate or sanctions, game over for even 4%. Now, the really scary problem, they have developed world demographics, but worse, they peaked years ago. You know how they pay for local government? Land. So how do you fix this? No evidence you can. That's the push for common prosperity. Essentially stating they're going to have to print a lot of money to keep the economy from crashing. So I'm bullish in that regard. Now for tech sector, this could be problematic. We have been facing a global chip supply shortage since 2020. Now 90% of neon gas, which is used to make the chips in Ukraine, is cut off, and 40% global palladium supply in Russia is now cut off. So this could be very problematic for the tech sector. There was a 2-hour call with Xi and Biden today. Xi was asking to de-escalate and create world peace. Here's a look at the pipelines. So in green, we have the gas, and red, the oil coming out of Russia. Mike Novograd says Bitcoin provides a great alternative to bad economic policies. CEOs that believe in crypto, Tesla, Uber, Apple, Nvidia, PayPal, Airbnb, Google, Microsoft, MasterCard, Meta, Facebook, Apple, Reddit, Twitch, Twitter, Morgan Stanley, Goldman Sachs, Charles Schwab. Mark Rubio says China is backing Putin 100%. Coinbase held 137 billion in crypto for institutions in 2021 versus 45 billion in 2020, a 204% year-over-year increase. Airbnb is looking to accept Bitcoin. It's the single most requested feature. Bloomberg says crypto applications for the iPhone could attract more than 1 billion new users. U.S. Treasury Department says Bitcoin's use for money laundering is far below that of fiat currency. Some pro-Ukraine quotes from this fellow. Zelensky's excellent military advisor predicted yesterday Ukraine could win the war in 2 weeks' time, unless something extraordinary happened. Russian troops can be expelled from the whole of Ukraine. The new U.S. military supplies, including high-tech drones with weaponry, might cause the end of the war. The incredible is about to happen. Ukraine appears it's about to defeat Russia and Ukraine. Russia allocated 100 out of its 170 battalion tactical groups to its assault on Ukraine. I personally don't believe that narrative, but either way, if there's a de-escalation, we're going to expect bond yields to fall, energy costs to fall, and go big on Ethereum. So we know the game plan. The Russian ruble is coming right back up. It had crashed 80% and has more than doubled since then. And that's because everybody's buying the oil at a discount. Okay, so that gets us a few days back in time. Yeah, EDC, I believe, is going to be the best performing major stock index this 5 to 10 year period. and probably with some volatility in about 2 years. And that's primarily because the U.S. is tightening policy. We're going to go to gridlock. Almost certainly the Republicans will take the House and Senate. So spending in the U.S. will slow down, and the bond market's going to keep correcting, and interest rates are going to keep going up. Meanwhile, China's doing the opposite. They're printing money and lowering interest rates. So bad economy equals good stocks. Good economy, tightening policy is what we're doing here in the U.S. All right, here's these bond markets for the U.S. We inverted the 7 over the 10 and the 5 over the 10 for a little bit. The 2 years now at 1.95. So the 2 years, what really predicts what the federal funds rate will be in the future. So they went up to 0.25. They need to catch it up to the 2 year to probably satisfy the bond market here. So more rate hikes ahead, and they'll probably drag their feet as slowly as they can until midterms. So I think they're going to hopefully be, we'll see. Here's the spread between the 2 year and the 10 year. So it's at 0.26. That means you get paid almost the same to loan money to the government for 2 years as you do 10 years. And that doesn't make a lot of sense, does it? Now, typically, if this inverts, then the next thing that happens is the front end stops rising and the long end starts to rise. And then you get a stock market crash and a recession, typically 1 to 3 years later. So this next period is actually good. It means the bond market's going to crash and investors are going to be forced into exactly what we're positioned in. Then the magic moment happens when interest rates get too attractive relative to inflation and growth, and everybody jumps ship and buys the bonds. And that's usually when the Fed stops hiking rates. So haven't done it yet, and we'll see how inverted it goes. But yes, this has done it about a year to 2 years before each recession, like clockwork, since the 80s. Here's the yield curve. We're looking at January of 2021. You got a nice yield curve. This is the shape that it's supposed to be. Very low interest rates for short duration, and get paid more and more money the longer you loan money to the government. If there's too much inflation, then the front end goes rocketing up, and that's what we've done. So you can see over the last year and a couple months, the 2 year has gone from 0.07%, or excuse me, 0.11, just barely a year and 2 months ago, and it's skyrocketed by, what is it, like 2,000% to 2.14. We can see the 7 and 10 year is still inverted. We did have the 5 and 10 inverted for a little bit. It's 0.01 off, and the 20 and 30 years inverted. So basically what we look at this is there's too much inflation. The Fed needs to fight the inflation rate hikes, but the people buying the long duration debt believe that will crash the economy. So they want it to look like this purple line and not like the blue line. So we'll see if aggressive rate hikes could bring this 2 year down and start to steepen the long end. So far, they've had no success. This is the probabilities for rate hikes in May. Almost certainly we'll have a 25 basis point hike. And this is what Jim Bianco was saying. You had a 40% chance of 50 basis points. That'd get us to that 75 basis interest rate. Marissa says, Jason, I always learn a bit more each time I watch your videos. It may take a while for it all to make sense in my head. But thank you for all your explanations. Yeah, of course. We're looking at the VIX futures term structure. So when we were crashing, you saw this was in backwardation. That means the front months were above the future months. And now we're in what's called contango. So that means the front months lower than the future months. I did not sell our UVXY position. It did rebalance to 13 from 17.5 as the long assets went up. And luckily, the long assets made a lot more money for us than the losses on the hedge. Unfortunately, I believe we have an unpredictable 2 to 4 weeks ahead with the war that could create volatility at any time. So that's really what I'm worrying about is more margin calls from either oil. We saw it with copper in China. This billionaire was negative billions of dollars. They rigged the market so he didn't lose. But yeah, we're seeing this extreme volatility. So it does make sense until the catalyst of problems is resolved. And that catalyst is the risk of Russian energy being cut off and skyrocketing costs, which affects the bond market. And that's our primary concern. The only cryptocurrency I like more than Ethereum for gains is a cryptocurrency called Polygon, ticker Matic. And so we can see it has greatly outperformed Ethereum, which has greatly outperformed Bitcoin since last May. So we do have a private equity offering to paid members only. You can reach out to Dean to learn about that. For every dollar we have in Ethereum, we have about 50 cents in Polygon. Furthermore, we're allowing people to trade between Ethereum and Polygon on the decentralized exchanges for income. And that's how we're able to provide a weekly dividend to shareholders. So if you are a paid member and you're interested in that, reach out to Dean and we'll get you on track to outperform Ethereum plus get weekly income. What does Polygon do? It's like the Lightning Network for Bitcoin. So the ledger is kept secure on the Ethereum proof of work, which is switching to proof of stake. But for lots of small transactions, we can cut the cost down from $30 a transaction to fractions of a penny on Polygon. So those two are partners in crime. And that's the only asset I see more growth in than Ethereum. And again, they are partners in this. Reverse repo back to $1.7 trillion. So I'm not going to freak out about liquidity in the money markets when there's $1.7 trillion sitting in reverse repo. All you really need to know about this is if this starts to dry up, we could start seeing volatility in the bond or stock market, as we've now officially ended QE. But it just stays at this elevated level here. This chart, we're comparing USO, BOIL, and NRGU. And so since the 9th of January, NRGU has returned 76%, BOIL 56%, USO 31. As you know, I rotated us out of NRGU into BOIL. And so we've slightly underperformed NRGU, which is 3 times leveraged big oil gas companies. But we've done well with BOIL. And again, the product I see that could give you a 10 times return is not NRGU, it's BOIL. It's a much smaller, finicky market that could be used as a war tactic here. And even if we don't see it used as a war tactic, Europe has openly planned and announced that they're going to reroute their natural gas away from Russia, which is going to drive natural gas prices up for BOIL over this entire year. So the longer this war goes on, the longer we'll hold on to BOIL. This chart, we're comparing lumber futures to oil. Last year, lumber futures crashed 2 months ahead of a sell-off in oil. And I had ignored that because I was certain oil was going to go to new highs. And so we had some pain last summer, ignoring the warning from lumber futures. And eventually it played out. I was just early. So we're carefully monitoring lumber futures for problems. And with the mortgage rate, interest rates going up so quickly, we potentially could see the deflationary shock hit lumber futures before oil and give us a signal that this deflationary pressure exists as soon as the war ends. But so far it's not, and we're seeing them trade highly correlated. Let me zoom out so you can see lumber futures went up to, this was 1600, crashed back down to like 600, and now it's back in the 1000 range. You can only see percent changes, but just extraordinary moves in lumber costs. So right now there's no deflationary data. In this chart, we're looking at copper versus gold. They call it Dr. Copper. If copper is going up faster than gold, it tends to predict interest rates are going to be pressured to higher yields. And so for a little bit, gold was outperforming. Let's see if I can get to, so over this period right here, you can see it was outperforming. But once China announced their plans to hit a 5.5% GDP and bail out their stock market, which happened only a few days ago, copper futures have been jumping. And with the Fed hiking interest rates a massive 25 basis points, the gold market sold off. I actually think gold might be a good play, or silver in the near term. So I haven't pulled the trigger on it yet, but I'm glad we got a little pullback for a new entry point. And let's just zoom out a little bit to see these. Amazing how well they trade correlated. Look at that over time. In this chart, in yellow, we're looking at interest rates. If yellow is going up, rates are rising. Green are the oil and gas companies in the US times 3. And the candlestick below is the NASDAQ. And so we can see rates fell a good bit here. And the NASDAQ did this massive rally, which is exactly what we've been predicting would occur, and that the bond market sell-off was overdone. Here's where China announced that they're going to bail out their economy and stock market, and this went flying up. We're long emerging markets times 3 in our safe growth strategy. So that was a huge win, and it was 25% of the portfolio. So we made back some of the losses. Now, if I zoom out, you probably won't be so impressed that I've been holding on to emerging markets. It's been in a sell-off for a year. In general, what I see coming down the pipeline is aggressive expansion of credit in China as the US goes into gridlock after midterms and has a hard time expanding credit while they're fighting off inflation. China's also not having all this inflation, so they can get away with money printing, and they need to prop up their economy. So I think we are probably at the beginning of a massive melt up in emerging markets relative to US markets. Now, again, till summer, I'm expecting the NASDAQ and crypto to essentially outperform everything. And that would include Alibaba and Tencent coming out of emerging markets or China, which were down 70 and 80% from recent highs. And we'll look at those charts in a minute. Okay, here's the Russell 2000. If the junk bond market's going to tank, we could expect IWM to have some trouble. So watching both of those for problems. And despite definitely jumping to a much lower level here, it has stabilized. So not getting a warning sign from Russell 2000 currently. Big jump up in Europe. It's still jumped out of its channel. And so all these disruptions to the economy are most likely going to eventually lead to more debt. Now all these countries are starting to essentially issue debt to expand their military and defense. So they've been just relying on the US to protect them, and now they're seeing that there's much bigger problems with Russia wanting to expand. So the money printing and the QE will probably get aggressive in Europe out of necessity. Again, good for stocks in that area. Let's look at the DXY, and the time emerging markets outperform US markets by 5-1 was this period right here. Okay, so we had interest rates rising, we had the dollar crashing. Now the DXY hit 72. I don't think the global economy can handle that, because it would essentially mean much higher interest rates. I will be surprised if DXY can hit 90 before we'd want to buy the dollar and US bonds. So we're carefully watching that. I think it's going to take 2 years to play out. So as the DXY falls, expect your stocks, your commodities, and your cryptos to skyrocket in value relative to the dollar. Dollar's going to lose value. The other assets are going to gain value. So we've been racking up really nice returns as the dollar's going against us. So get excited for the dollar to fall back to that 90 range. And that'll probably be when we do some pretty significant changes in positioning. Basically, go long the dollar, bonds, and the VIX aggressively and expect a crash or a recession. Okay, here's a look at the Chinese currency. So very little inflation for the Chinese. Their currency is extremely strong. Their imports, exports are record high. So despite the critique of China, that's really the healthy part that they're going to take advantage of and be able to expand credit while the U.S. tightens. And they tend to do this. They tend to take turns tightening and loosening at opposite times. Okay, this is where we're trying to predict when the hell China is going to start printing money and bail out their stocks. So if I zoom out a bit from peak, we can see Alibaba from that point was down 72% and Tencent was down 59. Now Alibaba is similar to Amazon. Tencent is a massive software giant. And then we got Taiwan Semiconductors with the chips, probably the most important company in the world, especially with geopolitics. So what we're looking for is we need these companies to catch up and start to outperform, and that'll give us a signal to get very bullish. So from here to here, you can see great outperformance. They jumped almost 30% in 2 to 3 days. And that's the way these markets work. They give you pain, and then if you're not long, you miss out on these huge jumps. This chart, we're looking at Toyota. And again, the chip shortages are going to be bad for the car industry. So very good way to see the impact from Ukraine, Russia impacting Toyota, which has been the strongest company in the EFO basket that we're playing, which includes Japan and Europe. So you just see this massive returns for Toyota. And then once this conflict really got deep, investors were realizing this would impact sales for Toyota, and we've had this huge sell-off, but it's starting to bounce here. So carefully monitoring Toyota. Steven says, will chip shortages be bad for car industry? Yes. Yeah, chip shortages are bad for anything with electronics, essentially. And the car industry has already been having problems with that before this. This is going to make that worse. Okay, so this is what I would blame the volatility in stocks on, was the sell-off in bonds here. So we saw all three critical bond markets, TLT, LQD, and J&K, all sell off. They did the similar pattern last year. So from, let's just look at the TLT. Okay, so right here, right when they did the massive stimulus, we got this bond crash, and then it quickly turned around and rallied all year. And so NASDAQ and crypto went flying up. Then we got another bond crash. And what happened? Same thing that happened last year of the same months. We got another crash in crypto and NASDAQ specifically. So what do we think is going to happen for the rest of the year? I believe this is greatly overdone and that these are going to stabilize for the time being. Now, I do see TLT having one more leg lower, but I'm expecting a relief rally into summer, maybe even into fall. So that's what I'm expecting. This is the Tesla to Ethereum comparison. So these have been the two hottest assets over the last few years, at least in the stock market, with large market caps over 100 billion. And this is indicating that perhaps Ethereum is a catch-up trade to Tesla here. Gold, silver, the supposed stagflation play or the central bank play. So if we see gold move up and silver's behind, there's potentially a catch-up trade. So I would probably play AGQ if I wanted to get into the gold or silver market. And so certainly there is this discrepancy. So potentially silver could be a good play soon for us. In this chart, we're looking at rare earth metals, uranium, and copper miners. we're in uranium and rare earth metals for the safe growth strategy. And I think your biggest money is probably rare earth metals for a surefire bet, and maybe uranium. And again, we're much more allocated to rare earth metals. Highly confident over the next decade, there will be massive shortages in lithium and cobalt, and rare earth metals is your play for that. That's a bunch of Chinese mining companies primarily. So some people have asked, would rare earth metals, RMX, go up if the US starts sanctioning China? Absolutely not, because that would be essentially embargoing, and that's why it's never going to happen. So I find that extremely unlikely, because it would be killing our own tech industry, which is where all the world growth has been. This chart, we're looking at the core inflation rate. This is excluding energy and food, so this is why this one's a lot lower. I was predicting it would come in below 6.5. It would top out next month, which is we'll get this month report next month, because this is the year over year where oil went negative. I don't think we're necessarily going to crash from March to April. We'll probably still top out. So I think we may top out next month below 7, trade high for a couple more months, and then fall. And essentially, probably a 30 to 60 day lag after the war ends. The longer this inflation remains elevated, the more problematic it becomes for the Federal Reserve and the bond market. So we'll be paying close attention to this. But that did come in below 6.5, which is what I was hoping for in terms of trying to anticipate when we're going to hit peak inflation, which is very important for how we position our portfolio. Essentially, if I'm right, we're going to expect yields to fall and for the Fed to be less hawkish and for the growth assets to really rally. So we're looking for a value to growth rotation. Last year, we were expecting a growth to value rotation. We hit it good. Sold a little early on NRGU. Now we're expecting the opposite, commodities to fall and the NASDAQ and cryptocurrencies to rally. Producer price index came in this week at 10. You can see it's stabilized. That's what I'm looking for. I'm looking for the rate of change of inflation to slow down, peak, and then fall. So if this was at 11 or 12, I'd be concerned, but it's been trading flat for 4 months. That's still going to drive inflation higher, but again, we're not worried about absolute levels. We're worried about the rate of change. I want to see this slow down and fall, almost like looking at a ball going up in the air, slowing down until it hits the peak, and then falling back down. Jobs market keeps growing rapidly. They change the data every month, so I don't pay too much attention to that. Wage pressures continuing. Rent continuing to rise. Labor force participation is rising. So the inflationary pressure is still there. We're just trying to predict peak inflation. Bank credit continues to grow, so we're not seeing any reason to jump out of stocks. People are getting jobs, banks are lending money. Consumer credits continue to grow. This was a lot lower. A lot of people were seeing the savings rate drop last month, expecting a massive run up in consumer credit, and it fell. So that was a surprise. The retail sales jumped 4.9 and up 0.3 again. So the consumer remains very strong. So no reason to freak out about stocks right now. Consumer spending hit a new record high. This is a good way to predict the dollar. So if we're going to run twin deficits, we're going to import more than we export. New record in January, and we're growing the deficit. So that's the perfect combo. I've added a new slide that we don't normally follow. New home sales, super strong housing market, even with these interest rates rising. Chinese imports, exports, they seem to have combined January and February. So it did slow down to about the October level, but still very, very healthy imports and exports. So no sign of a global recession about to incur based on the Chinese data. And now they're going to expand credit. All right, this is where the Fed's balance sheet ended up, just shy of 9 trillion, $8.954 trillion. So now the big timing is, when will they let the balance sheet run off Rate hikes, I'm not too worried about. In the first few rate hikes, the balance sheet runoff could be more severe for risk assets. So we'll have to pay close attention to when they actually do that and evaluate if that's the time to go long bonds and the dollar based on the health of the economy. Okay, ECB still growing its balance sheet. And so that is the main stuff we view in our Monday, Wednesday, Friday webinar. So now we're going to jump into the exact asset allocation of both strategies and talk strategy, buy and sell alerts, what I'm expecting to happen next. If you're not a paid member, this is where your video ends. So call Dean to upgrade at 505-322-7515. Okay, let's look at some of these questions. Larry says, can Tesla sustain its growth? Well, they need the chips and they need the lithium and the nickel and the iron. So I believe they've actually been investing heavily to develop that in North America. So that's smart. The chips, they're not going to be able to get around. And we had Elon actually put out he likes to front run the bad news. So he put out this survey about inflation on Twitter. And then a day or two later, raised all the prices on the Tesla website. So pretty funny on that front.